think this is our third time together, so thank you so much for taking the time.
Thank you for having me, Christopher. It's always a pleasure.
So just a short summary of, 2025. We're almost halfway in. Are the broad topics, volatility, uncertainty, or how can we just frame it super quickly at the beginning here, shipping markets and markets in general?
I think volatility is a key word. Exhaustion could be another one, and opportunity, of course, is maybe a third term we can coin on today's market.
Definitely. So just for people who haven't, heard you before, let's recap a bit. You came from sort of a background of being an analyst and you found a competence in econometrics, etc. But can we paint the picture before going over to Gersemi, the shipping fund, a bit of your journey for people who are totally new here?
Sure. So I came into the industry in 2011. I started as a junior analyst equity research in Nordea Markets. And then I basically played a chair game a few years in investment banking. So I went to Furness and I had a brief a few years in Santander where I managed an investment grade bond portfolio. But I always kind of early on I knew I really wanted to explore the fund management pathway. So early on in my equity research career, I started applying econometrics to shipping, which is highly cyclical. So I thought maybe econometrics is a good tool to apply. And from from the university, I have a master extension in fund management and financial econometrics. I noticed that the industry was not very comfortable with econometrics. Not many people wanted to either look at it or speak about it. But my models were quite good at forecasting the cyclicality of shipping, as long as you don't have any kind of fat tail demand events and so on. So it was for me it was quite obvious that this was a big opportunity. And then I started Norwegian shipping hedge fund in it was 2021, and then that was a tentative and a temporary structure due to the tax leakage. And then I started under a partnership, an Irish fund, and then I unfortunately had to close down that partnership, and I started then Gersemi Shipping Fund and Gersemi Asset Management on my own. So we have been we incepted in 2023. And we currently have around 30% return since then, slightly lower than the historical average I've been able to provide, but still better than most peers and other natural benchmarks.
Definitely. So we'll come back to the fund, but you told a story about, joining these shipping firms and, bringing your econometrics models. And is it fair to say that shipping is a bit based on gut feeling, pattern recognition, and not necessarily finding the commas in the Excel sheet all the time?
It's a very interesting industry when you kind of get to know it, because it's a very asset-heavy industry. There's so much money involved in shipping. But the investment processes can vary from extremely time-consuming and thorough and professional. But you also see a lot of investment decisions being taken on a yacht in Piraeus late hours. So it's very interesting, and also it's like a textbook example of a perfect market. Everyone are price takers. So no one is able to kind of to affect the market. So that means when times are good, everyone is scrambling for new buildings and second-hand tonnage, and then you get a huge order book, and then that usually or often tends to collapse the market and send the market into a trough cycle a few years later. So it's a very interesting dynamics.
Yeah, it's fascinating. So you said you have set up your own fund a couple of years into it. I wanted to start with the psychology of doing trading and investing. from a broad picture, what do you think are some of the biggest misunderstandings of operating a hedge fund, doing trades day to day?
I would say it's not that many misunderstandings maybe, but it's at least in shipping the news flow is continuous, and you're kind of narrowed down to a small universe. There's not that many stock listed shipping companies which have enough liquidity and good enough corporate governance and all these kind of things. So it's a narrow universe. But the information flow is continuous. You start in the Asian market and you get the forward freight agreements are trading, you get fixtures, and then it trades all the way around to the US market close. So there's lots happening all the time, and you need to, it's kind of an information overflow, but you need experience to know which data points are important and which are not. And also it's important to be plugged into all that information so you get the information, because there's a lot of time lag in much of this information which comes across our screen early, but then maybe people or laymen, they read about it in the paper the day after or something.
Got it. So, working as an investor or a trader, for many people tuning into this podcast, it's probably one of their dream jobs, right? But doing it as a retail or on your own versus, having a fund, having clients, any some points on that it's a bit of a different world? You can't just do it as you would yourself, or not really? You can.
It's a good point, because I've been at all sides of the table. I started investing in shipping when I was maybe 20, 21. I was a student, and at that time I was always kind of a day behind in information flow. I could see share prices react maybe 5%, but I didn't know why until the next day when I saw there was a strong cold feature out of eastern coast Australia, for instance. I would say if you are a retail and you want to invest in shipping directly, you are unfortunately at a disadvantage out of the starting gates. So you could potentially compensate by doing other things, but that's the unfortunate reality, I would argue.
Yeah, makes sense. So last week I listened to an interview of Ken Griffin, the founder of Citadel, and he said that being an investor is one of the hardest jobs because the best stock pickers at Citadel average, in alpha terms, 55% correct decisions at a time. So to be able to do a great job as an investor, you need to understand that, to just be a fraction over 50% is maybe that's what's going to determine how good you are investing. Is that the same when you do trades? Do you feel that, it's about being maybe 55% right at the time? And you have to be mentally adapt and don't really, think about trades you put on that didn't work and then, start from the beginning again? Or how does that dynamic work? Because investing is one of those industries that is a bit special in that sense. That is about how hard you press the winners and how fast you cut your losses.
I think it's a very interesting point. I could argue that if you're right 51% of the time, you're kind of adding value. Obviously, we are aiming much higher than that. But we did a count during the, not this quarterly season, but last quarterly season in February. And we counted we do a lot of short-term trading around the quarterly results, and we counted how our success rate. And I don't remember the exact number, but I believe it was in the 70s, 75%, something around there. And I think that reporting season was one of our less successful ones. So in terms of the short-term trading, we're quite successful, I would argue. And we have made a lot of money for our investors during those short trades. But our kind of main strategy, maybe we can get more into that later, but it's the more fundamental view, the longer term views. And I don't know if I could easily check, but I don't have the number in my head. But the success rate on those long-term investments, I would think is closer to the 70-75 mark than 90 or 50. So we do obviously have trades that are not going the right direction all the time. That's kind of the nature of managing a fund. We are not able to predict the future with 100% certainty, obviously not, but we do aim a lot higher than 50.
Yeah. But like you said, the returns have been highly successful for a long period of time, but if I understood the metrics correctly, the last couple of months last year were challenging in terms of the returns. I think it was October, November, December. Can you just explain how you handle those months? Is it just, new day, I forgot about the losses and keep doing the same? Or is it at some point a bit mentally challenging to have those months that will come eventually, whatever you do, right?
Yeah, you cannot manage a fund without having drawdowns once in a while. But it's a lot I could say about that period. It was an interesting period. I would say that one positive thing during that period was that our investor base is very stable. So we had only one or two redemptions, and I think only one of them were because of the drawdown. The other one was a real estate development project. But it does something with the feeling at the office. Obviously, when you're losing, one thing is to lose money one day and you make money another day, and it does something with your feelings. But you have to kind of, it's a natural part of the business. But during October, I think we had a big drawdown. So you lose money basically every day you get into the office. I think it was up towards 1 percentage point each day, and that's extremely exhausting. But what we do in those events is we have a mathematical approach to our investments. So we find a big comfort in kind of going through all our models. Is there something we have overlooked? Has the fundamentals changed? But what we kind of landed on, we saw that fundamentals were basically the same. Pricing were down, so we after a while we started buying, and we bought. We transitioned from kind of reduced our shorts and bought more longs. And I remember just before Christmas, we kind of went all in because we were having some discussions, talking to people, and one impression we had that it was maybe a liquidity event. Some big US generalists, or maybe several, wanted to divest their positions ahead of financial year end. Just because they didn't like Trump, they didn't like the headlines on trade war and tariffs, so they just wanted to get it out of their balance sheet before year end. And also pricing were just ridiculously attractive. So we even bought dry bulk, which you usually don't do in December because of the seasonality. It usually collapses into January. But we bought basically a lot. Oil tankers, dry bulk, we had a lot of other positions. And that was, January was our best month on record. So that's kind of what we do, rely on the math. We see through sentiment, and we employ capital in a rational way, but we do feel the hurt going down. We are ourselves invested in the fund, so it's and we feel a large responsibility for all our investors. So yeah.
So to summarize, it's a bit about being greedy while others are fearful, or pulling out of a position, or.
Yeah, it's the famous saying, being greedy when others are fearful. But it's about the mathematics. It's about the fundamentals, and it's about pricing. So if you see pricing as attractive and the risk reward is attractive, you do the rational thing and you employ capital. And in my experience, that usually gets you the high returns we have delivered historically.
So talking a bit about the investment process, where do the best investment opportunities come from? You described a bit the news flow. Do you think it's about, responding quickly to signals or something unpredictable like COVID or Trump? Or is it about, using the sniper, doing the fundamental research, and when the stars aligned, you sort of take the sniper and make the kill shot?
So there's, we kind of started the fund, or the strategy behind the fund was at first kind of the fundamental, the cyclicality, the econometrics. But what we have seen is how much value we can add by doing more short-term trades. Just to start off with the kind of the backbone strategy of the fund, it's the fundamental cyclicality. So you have kind of supply, you see the fleet growth coming from the order book, which it usually takes 2 to 3 years to build a ship. So that's very transparent. And then we spend most of our time on the demand side. And if we kind of figure out those two variables, you get fleet utilization. And if you have fleet utilization, you can deduce basically all other numbers like earnings and asset values and share prices. So that's kind of where we're coming from. And that's, I would say that I haven't seen anyone else employ that approach. And that has been very successful since now 2014 or 2013. Basically predicting all shipping cycles where there have not been a fat tail event like COVID or a dam collapse in Brazil and so on. So that's kind of what we launched the fund on. But what we have seen after now 2 years of managing this fund and also the preceding funds is we can add a lot of value on the more short-term trading. So for instance, if we see a company, for example, we shorted MPCC ahead of their quarterly results now a week or two ago, or in May, anyway, because we thought valuation was rich, and we also saw a risk on their dividend distribution. And they announced a cut in their dividend policy during that quarter, and we made a lot of money and we closed the short the next day. So that's a lot of value we add. We are able to predict quarterly results, management policies, and so on. And then it's the information flow, which is also quite asymmetric across shipping. So we have those two strategies I mentioned now is very proactive. We take positions and we predict the outcome of an event. But these other, like Trump, fixtures out of Arabian Gulf, all these kind of things, we are more reactive in those events. So whenever we see those events, we are basically, from a time frame perspective, we are aligned with the rest of the market. But where we are able to add value is that we have a lot of experience and we know exactly what to do. We know which data points are important and which are not. And 99% or 99.99 are non-important. And we know exactly what to do when those important data points come. So we are also able to make money being reactive, but moving ahead of the market with just kind of adding what moves the market is, in my experience, is often a US generalist, which then tends to maybe talk to a shipping analyst or have to go through an investment committee to make the investment decision. So it's a bit time lag there, which we don't have because everything is in-house. We are basically working as a hybrid analyst and fund manager, and all our models are in-house. We don't need to talk to anyone. We just make a decision.
And like you said, maybe shipping is a bit unique in that sense that, okay, it's quite niche. So if you're short Tesla, for instance, because of the fundamentals and that the valuation doesn't make sense with other car companies, that's maybe a bit different. Maybe it's a bit more dangerous to be short those types of companies than, I don't know, a shipping company where you, like you said, if you forecast a dividend policy shift or something like that, you will at least tend to think that the market will react.
Yeah, but it's always, we didn't know that MPCC would cut their dividends this quarter, but in our models are telling us they would have to cut the dividend. The same with Cool Company and Awilco LNG. But then we kind of hit the quarter because it was obvious, for instance, with Awilco, it had to be that quarter. Yeah. If not, the management would not have done their job correctly. But
my point is that just that, Tesla, there's more intangibles in those analysis, software, autonomy, who don't know, something on Mars. Shipping is steel on the water. Maybe it's a bit more, fundamental in that sense, maybe.
Yeah, I wouldn't know too much about Tesla, but I agree with shipping. It's very easy. You have the asset and you have the cash flow. And when the cash flow is not sufficient to pay dividends, you need to cut dividends or you have to cut debt payments, but that's further down in the stack, so no.
Yeah, but So if I understand you correctly, those short-term trades and shorts in general has been an active part of the fund. Maybe that's not as typical because maybe shipping investors tend to buy an equity hoping it will go up.
Yeah, correct. Shipping is cyclical. It's capital intensive, and I would say successful or the most successful listed companies we have seen over the past 20 years have been those who have distributed capital when they have made money, and when they come into the cyclical trough and are losing money, they ask maybe the same shareholders, we need to be capitalized again because we are on the brink of bankruptcy. But we want to employ that capital buying more vessels because now they're cheap. On the other side, we see companies hoarding cash at the peak of the cycle, not giving cash out to the investors. And because the argument for some of them at least is they want to retain that cash to invest when things are looking good again. But we as investors, we want that cash out now. We want the cash to employ in other segments which have higher expected return. Anyways, it's important to be able to short these equities, I would argue. You can employ a long-only strategy, but then you have to have cash positions during the cyclical contraction. It makes much more sense to be short. So at present we have 9% net short in our fund because we believe the cyclicality of most shipping segments are at peak or have peaked, but we are a long-short fund. So we can make money in any market. That's the way I believe you need to be set up in shipping to really make a decent return across cycles.
Just finishing, the universe you invest in, we have sort of heard about the equities and the shipping segments, but debt, forward contracts, offshore market, offshore vessels, what is on your radar? And is that also a constant debate? Should we add the universe slightly to go more offshore, or we're going to keep this shipping and then look at debt or forward contracts in addition, but mainly the equities, short and long?
So we have a very wide and pragmatic mandate, but we are focusing on shipping purely. And for us, that means not cruise shipping and not offshore shipping. We are focused on we prefer commodity shipping like oil, petroleum products and dry bulk products and gas and so on. But we can also do more industrial shipping. There's nothing wrong with shorting Williamson, for instance, for us. But in terms of investment instruments, so our approach is basically we look at the fundamentals, we identify which is going to kind of contract and which is going to expand, and then we employ capital given the upside or downside and the risk to each of those segments, and we get a balanced portfolio plan, and then we look at what investments or assets we wanted to employ our capital in. And since October, maybe, NAV in shipping companies has been quite low. So it's been attractive for us to employ capital in equities. In January, we saw the opportunity to employ capital in the forward freight agreements in dry bulk because they were quite low. So we made, it's much more elastic. So we made 60% on that FFA trade alone over a month. It's very elastic, so we don't take that big position that we would otherwise in equities. And when you have a kind of a cyclical contraction and trough, we will be looking at kind of bonds and mezzanine because that's when, in our opinion, you want to be investing in those type of instruments, depending on pricing. Then we would potentially look to pay 50 cents on the dollar for a shipping bond if the market thinks they might be bankrupt or not able to repay the loan, but our models suggest that they will be able to, or we can get an attractive conversion into equity.
Perfect summary. So let's dive into markets. Let's start with some overrated shipping segments the next 6 months, to use that as a base case. What is overrated right now in shipping?
So I briefly mentioned our short in Williamson. We are short car carriers broadly, and we are short containers. And given now the recent price appreciation in both segments, we have increased our shorts. For us, it makes a lot of sense. It makes sense from a portfolio management perspective. We are de-risking our Red Sea reopening. We are de-risking kind of the tariffs and the negative sentiment from global trade and negative trade growth potentially. And also we are fundamentally short these two segments. Both segments have had or are in the midst of big fleet growth. We see limited demand growth in both segments. And again, valuation now coming up since early April. And then we shorted them down from some of them from 130 down to 60. And then now they come up again to 80, 90. And then it's natural to add on shorts at those levels. And also containers, we are shorting broadly. We have a big short position. And it's very challenging to see the upside risk in equities, but it's very easy to see the downside risk. So for us, it's a very attractive risk reward.
What will be the net effect of a full opening of Red Sea, for instance? Because that's been a huge driver.
Yeah, it's huge. For containers, I think it's 10 to 12% demand growth demand that is removed from the market. We did see last week CMI, CGM talking about reopening their Mediterranean Express through the Suez. We also heard chatter about Evergreen and Yang Min doing some similar moves. It's at this stage, it's the number of transits at face value is very low, but the theoretical effect of someone starting to go through the Suez Canal is huge, because as soon as someone goes through the canal, it's like a prisoner's dilemma. If they make super profits, everyone has to do the same, and then no one is earning super profits anymore. Everyone's just earning less. So it's a perfect kind of short equity fundamentals. And then Egypt is having implemented that 15% discount on the larger container vessels. There's a lot of incentives, and for the segments that is most affected is containers, it's car carriers, and it's product tankers. And last week, when oil tankers had a very good week, and they have been moving up a lot since early April, we took the opportunity to divest some of our, mainly focus on product tanker longs, because it also fits into what we think is very interesting news last week, which I think the market really didn't price in. We'll see. Maybe it's not that significant as we think, but we will see. But we wanted to take some chips off the table, or the Red Sea table, and it made sense for us then to also divest some product tanker and take some gains as we head into what is usually a very seasonal, sluggish period for oil tankers.
I was trying to look for some, bright lights in the car carrier story, and I don't know, if China takes all the EV market, they weigh more. Do you need to stack them differently in case of fires on board ships? I don't know if that's gonna make any difference. I don't know.
I think that's on the margin, if anything. Yeah, I think you should look at how many new buildings are coming on the water, and be fearful of opening of the Red Sea.
But one other point I would just mention, I know you talked about MPCC, but in a recession, let's call it something that looks like a war economy, I don't know, onshoring, new alliances, is there something to look at? I mean, the feeder market, more regional trades, closer to home. So that market is, I wouldn't say protected, but maybe of a niche that can survive better in a recession, onshoring, alliances, I don't know, story?
There's always the argument, and I will give you that during or in the aftermath of the Russian invasion, you had a period where product tankers clearly traded kind of in a little bit of isolation from the crude tankers, and also in dry bulk during, I think it was during the heights of the pandemic, I think, or slightly afterwards. Anyways, the smaller segment vessel classes were able to outperform the larger. But I would always argue holistically, you have so much cannibalization between the vessel classes, between a crude tanker and a product tanker, between a Capesize and a Panamax. We saw that last year whenever the Capesizes were earning twice the Panamaxes, and the Panamaxes were having an abysmal market last year. Instead of the Capesize moving the Panamaxes up, they just drag the Capes down again. And for containers as well, we saw a lot of cascading in the mid-2010s to my recollection. And I have a hard time seeing how one isolated vessel class within a broad sector can significantly outperform when there's so much cannibalization on the upside and downside. But that said, it has happened before, so you cannot rule it out, but I don't, that's not our base case. Yeah.
Got it. So let's take a segue over to, the most exciting shipping segments going forward. I know you have two segments that is, interesting. Which one do you want to dive into first?
We can start off with oil tankers. I think oil tankers is at an interesting point. Our models are clearly telling us that we are around peak cycle. The question is, how long is the peak cycle going to last? We have had very low fleet growth now for a couple of years or a few years, and the next 2 years we see slightly higher, but not very high. I think it's around 3% annual growth. That's not very high from an historical perspective, but against that, it's all about the demand growth. And now with also extra strains on global economic growth, it's challenging to see kind of what will drive consumption of oil in the coming couple of years. But what we do see as very interesting is you have, regardless, a big supply push in oil. And oil tankers are driven by the supply of oil, not the demand of oil. But arguably, you need demand in the medium to long term to have high supply. But in the short term, you can have a divergence. So you can have high petroleum supply without having the sufficient demand. So then you will get an inventory build cycle. And I think the Chinese could be very interested in building inventories at $60 a barrel. And OPEC Plus is now during also this week, and they announced the third consecutive monthly incremental increase of 411,000 barrels per day. And we have Guyana and Brazil coming online basically now. So we have that as a second half of this year scenario. So as we view it right now, all stars are kind of aligning for a very good market from October this year. Equities are also fairly priced. They are slightly below on P/NAV valuation historically. So we have divested some oil tankers long, but we are still around 25% invested long oil tankers, which is a substantial part of our portfolio. We are looking to potentially pick up more exposure if prices come down again towards September. But the two key questions are so what will happen in the next 6 months? We are bullish, and you also have a lot of tailwinds from political events like sanctioning of the fleet, potentially secondary sanctions of Russian buyers of oil. There's a lot of support in the US Senate, as far as I understand. And then you come out into 2016, and then kind of you have to reshuffle the cards. You need to look at where are pricing of equities? Where is the pricing at the moment? What's the risk reward? Is it attractive? And then potentially you should take some chips off the table. But for the next 6 months, it's a very interesting story.
It's one part that makes this a bit difficult for investors, the fact that the expectations have been very high.
Yeah, last year we had a big disappointment in Q4. It was one of the worst fourth quarters earnings wise to my recollection. So and the expectations were so high. I remember coming out of summer last year, we had an internal discussion at the office. We looked at our earnings estimates for Q3 and Q4, and we saw we were far ahead of consensus, and that's often a big red flag. But what we expected was consensus to revise. But what happened instead is that when they reported quarterly earnings, they disappointed hugely. But then also equity pricing were already very low, so it's challenging to short a company when equity pricing is very low, even though analyst expectations are off the mark. So it was a very challenging market to navigate. We like markets where everything kind of points in the one direction. That's very easy to take positions on. But that market everything was pointing different directions. So it's more challenging. Yeah, expectations are high, but pricing in equity is not reflecting that, I would argue. So it's an interesting time to be looking at oil tankers. Maybe you can even get them cheaper into July or August, maybe.
But it's a fascinating segment because looking at Twitter and all these smart people doing their analysis, it seems like there's often a thin line if you go on bull side or bear side, because there's so many moving pieces, and I don't know, like the markets tend to be unpredictable.
Yeah, I think the ones that are pricing shipping, again, I would argue it's the big money. It's very often the US generalists. I remember from my equity research career that being in bearish or negative on social media was not very popular. It's a very positive bias on social media, I would argue. And that's not necessarily driving equity pricing. That's kind of the big money, the US generalists. And also there's a lot of smart, shipping focused money here in Oslo, but which often have a certain impact on equities. But I would again argue it's the US market that over the past at least 10 years have becoming more and more dominant in driving also intraday pricing of equities.
How much is the Fredriksen premium in Frontline priced into your econometrics models? Do you give that an extra premium if the market goes, or not at all?
I think we have 1.1 or 1.15x premium on Frontline versus pairs, where the pair average is 1.
Can you explain that to people tuning in, why that's given?
So just kind of to explain our valuation method, it's important for us to use the same inputs into our company models and also the same valuation matrix, so we get kind of the comparable results. But then on top of that, and our valuation matrix is basically weighted on NAV, yield pricing, and so on. And on top of that, we do a subjectively assessment of each company. So if you are a Greek owner knowingly having a lot of straws into the treasury of the company, or you have a lot of unexplainably high OPEX or G&A or all these kind of things, or have a history of issuing warrants, it's a lot of things, we apply a discount to that company. So in practical terms, that means if the company is cheap enough, we argue that everything has its price. At these levels, we are willing to invest in this company. And for Frontline, that's kind of the opposite sign. So we say that the premium is historically 1.15, around there. So we are willing to pay a premium. And reasons are investor friendliness. He has a track record of investor friendliness. I would say that the Golden Ocean transaction with CMBT was a big stain on that reputation. And then it's a high liquidity, and it's been very well driven or managed, good company management over many years. and they have a good dividend distribution policy, so you know you're getting your money back if you're right and the earnings come up. So it's a lot of good arguments for us, at least, to have a slight premium on Frontline and a slight discount on some of the other peers.
And then if we can touch upon, you know, the very large gas carriers, that segment, you also see opportunities going forward that can be interesting?
It was for us coming into 2025, it was one of the most interesting plays. We wanted to be short coming into January, February, and then we wanted to flip the position into a long position as we came closer to the summer. And what we have seen is, I think, was from maybe November last year, U.S. terminal capacity on propane and butane and isobutane and all these kind of LPGs was getting close to 100% utilization. And you have a very important part of that market, which is the pricing differential between the US and the Far Eastern market. And that's very often a big pricing differential. So there's a lot of money in the business of moving gas from the US to the Asian market. The question is, who gets that arbitrage? And for long periods, it's shipping. So if you have ample terminal export capacity and you have constraint on shipping, then shipping can basically take 100% of that arbitrage. But what we saw from November is that the terminal capacity was close to 100%, and then suddenly the sentiment shifts, and then the terminals are getting the arbitrage. And that continued into this year, but has now normalized again. And what we are seeing is around now, it's ramping up a big, I think it's 20% export capacity increase in the US. It's a huge project. So when this export capacity is coming online, you have potential to export more gas. The terminals are much less have much less pricing power, and the shipping could potentially again become the constraining factor. So it's very interesting, the dynamics that can occur during the second half of this year. The problem now is that, as with so many of our other investment ideas, it's getting kind of a lot of noise from the political stage. So it's with the trade war with China, it's that's kind of one of the main markets for US LPGs. So that's a big uncertainty and negativity around that case at the moment. But we are closely monitoring the situation. We find equities cheap at around 0.6 p NAV, but we need to see cargo flows increasing again, or into the Chinese plastic production and so on.
So the thing that you're saying is that, you know, from a fundamental perspective, it looks interesting, but given the policies and the potential trade wars, you know, routes can be shifted, you source from different countries, and you need to map out sort of the consequences of that situation playing out.
Yeah, it's interesting. We have seen that been mapped out quite extensively already. So we have seen shifting trading patterns. So the VLGCs are earning around $40,000-$50,000 a day, which is quite high versus the historical average around 30. So you have shifted US volumes into, I think it's maybe, was it India taking a lot more? Anyways, other countries in the region. So the ton-mile effect is still there. But the arbitrage is not there. So it's an interesting market to see cargoes being shipped, but the arbitrage is not there. So it's a lot of economics going kind of outside the normal trading arbitrage. It's an interesting market, and if trade relations normalize between the US and China, I think it could be a stellar market during the second half of this year. And if not, it could still be a quite decent market.
Yeah. And if I understood some of the slides I looked at yesterday, there's a relative modest fleet growth. And a big push for ammonia wouldn't hurt either because you can transport. It has the same properties, so it will also be beneficial for the segment if ammonia takes off in the future as well.
Yeah, I think many of the new vessels coming on the water are kind of LPG, ammonia, can take both to marine collection.
Yeah, definitely. That was the point of the slide. So some of the trends look promising. But then maybe the most fascinating thing with shipping is that it can look good from a fundamental perspective, but it can also change very quickly.
Yeah, so from our perspective, we don't like all the noise because that would make so much easier investment decisions. But yeah, it ebbs and flows constantly.
And maybe for also people tuning in is that one thing is having this conversation today, listening to your perspective, but maybe in a couple of weeks' time, it would have been another perspective because things have happened, right? So you need to be very adaptable, I guess.
Yeah, very good point. All the things I've said today might not be relevant in a week's time. Hopefully they are, but you never know. That's a very good point.
So rounding up, first question, just given the market in total, I mean, we didn't really dive into dry bulk. I know you can say a couple of sentences if you want to, but just general, what I'm hearing that I found a bit interesting is that you're saying that, it's been a great cycle and the party is soon we're closing the bar soon, it seems, in broad terms. It's been some fantastic years. Is that some of, a key topic to have in mind, that if you look at the cycles, we're sort of maybe ending something very good soon, and then maybe tougher times will come as a general topic?
Yeah, I agree with that general approach. So what we have seen is one of the best shipping cycles in very, very many years. You had a very good one in 07, 08 as well, but at least since then it's been not that big or good cycles for equity valuation. And one reason has been new building prices. So so what do you want to do in the cyclical trough? You want to buy, you don't look too much at yields, you want to buy NAV at a discount, and you want to bet your money on increased earnings and asset price appreciation. And to get asset price appreciation, you need kind of two things. You need earnings to come up, and you need new building prices to come up, aka the replacement cost of your vessel. And this cycle we saw new building prices being driven up by LNG carrier new buildings and container vessels being ordered en masse. So then you had support from one of them, and then you got earnings support, for instance in oil tankers, so you got the yield. What we're lacking now is the yield. We have support from new building prices. So what we are focusing on in the current environment is we are more focused on yield than NAV versus what we would be in another market. And what we are watching most closely is new building prices and the forward book of the yards. So what we expect will happen this shipping cycle, as it usually always does, is that shipyards will get less orders because pricing is high, and now we also have an added element of regulatory uncertainty around fuel types, and you don't know how much you need to invest in the new building 10 years after delivery. So it's harder before you could have 25 years remaining life and you can do the calculations, but now you basically have much less visibility on the life of the vessel and the capex included in that life, and so that's kind of what we're looking at. So watch out for falling new building prices, and if you don't see yield, you might not want to pay a premium to NAV at peak cycle where we are today.
What are the future goals for Gersemi, the shipping fund? Is it to scale it, bring more money into it, or do you like to keep it lean and effective and agile?
So we have our strategy, which is light-footed. So that means we need to have a low AM. And being one of the biggest investors myself, my colleague Frederick is invested with his wife. So we are kind of, everyone is in the same boat, so we will never grow the AUM beyond the point where the strategy is infringed.
And where is that point?
On our calculations, it's between 100 and 200 million dollars. So that's a very small fund in the bigger picture. So that's kind of just what we're focusing at the moment. Just growing the AUM slow and steady to the benefit of our current investors and our future investors, but all focus is basically on giving returns. Our experience is that as long as we provide returns, people will approach us and ask about the fund. So we do very little marketing. It's I think it's a year since the last time we did something similar, or I did something similar like this. So we're not doing any marketing. We're just focusing on delivering returns, and then hopefully we can have happy investors and a happy life.
That's a perfect ending, Joakim. Just final question. People who are curious, where can they follow your work? I know Twitter is one place. Is it a newsletter for people who want to tune in and get some information? Where can they reach you?
Yeah, so we just relaunched our web pages at gersemiam.com, or just Google Gersemi Asset Management. I have a following on Twitter. We share some information there. And now you can also subscribe to our monthly newsletter on our web pages. So that's some of the ways you can get in touch with us.
Perfect. Thank you so much, Joakim. Really appreciate it. And yeah, best of luck.
Thank you so much, Christopher. Thanks for having me.